Hello everybody, William Jordan here, and sorry about the look. It's been a long day and it's 1 in the morning and I'm recording this video for you guys. This is just a quick introductory video on trading, more specifically day trading. Okay, so let's get right into it. So what's the difference between trading and investing, you might ask? Well, there are many ways you can define the differences, the way you study the market, the way you choose when you're in and out of the market, etc. But in general, it comes down to time frame. Investors will buy shares, buy equity, buy into a company, or invest in a certain way and hold on to those investments for long periods of time. Days, weeks, months, years, decades even. Okay, some investors will even hold on to their investments indefinitely. There are certain bonds out there you can invest into for hundreds of years to come. Now, investors, like I said, will hold on to their trades for extremely long periods of time. They will pass it down to their children, to their children's children. They will hold on to their investments during market surges and market crashes. Whether you're in a bull market or a bear market, recessions, you name it, certain investors will sit through it all. Where traders, on the other hand, are in and out of the market in shorter periods of time. A couple of days, hours, minutes, even seconds. And especially with high frequency trading and today's algorithms out there, some traders are in their positions for fractions of a second. Okay, it can go extremely fast. So it all comes down to, for the purposes of this video, to the time frame. Okay, traders are in and out of the market in extreme short periods of time. In day trading, you hold on to your trade for a couple of hours maximum. By the end of the day, you will make sure that your positions are closed off before the market closes at the end of the day, and you will almost never keep a trade running overnight. It happens in certain situations, but in day trading, it's extremely rare. It does happen, but extremely rare. Another major difference is that investors generate long-term growth. It's them that create the funding for companies and government, not so much for traders. Since traders are in it for the very short term, they create volatility. Traders are there to force the supply and demand into balance. Now, for those of you out there who think that trading is easy, that you sit behind a computer all day, every day, and with a click of a mouse, you enter your exit positions, kind of true, but not quite. You buy and sell stocks, and that's all you do. It's kind of a bit more complicated than that. Okay, I know with today's algorithms and copy trading and technology out there, programming languages, etc., trading has become a bit of an easier thing for a lot of people to do, but I still think it's good to understand the general idea and thoughts behind the whole trading process. Trading can be really complicated at times. Now, most traders fail. Actually, around 80% of all traders fail within their first year of starting trading. Traders have to make really fast and stressful decisions, sometimes reacting to blips in less than a second. Day traders, when closing their positions by day's end, which of course limits their downside risk, but on the other hand, in certain situations, it can also limit the potential for any future gains. Trading all in one is a job of patience and fast work. Sometimes you have to wait for very long periods of time for an opportunity to arise. And then as soon as that opportunity arises, you have to be really fast thinking, really fast on your feet, really fast on your keyboard and mouse to get into that opportunity before it passes you by. Sometimes it will feel like the market is flatlining. Nothing of interest happens. It's just there's no significant movement in the market which allows you to study for or get into a position. And since there's no opportunity on the horizon, you get really bored at certain times. And then at other times, as soon as an opportunity arises, you have to be really quick to get into that opportunity before it passes by. It is a job of patience and fast work. At other times, it can feel like all your trades are bad, that you're not making any money or even losing money in the market. Now, just imagine to yourself, you're sitting there all day long, waiting for an opportunity to arise. When the opportunity arises, you grab onto it and you end up losing money anyway. That can be really challenging for a lot of people. Trading can be very physically demanding and mentally tough. Traders also have to face off against some of the toughest opponents out there. Since trading is a zero-sum market, it means there's as many losers as there are winners and as many winners as there are losers. And because of this, traders have to face off against other traders all the time, and there are millions of traders out there. Traders also have to face off against high-frequency algorithms, which are computers operated and programmed by hedge funds and brokerage firms that place trades at lightning-fast speeds. Normal humans cannot compete with these algorithms. The time it takes a trader to click and place a trade, the algorithm has already placed thousands of trades in that same period of time. Humans just can't compete with a computer when it comes to trading. To be a successful trader, you have to be willing and prepared to face off against this kind of competition. Discipline is another factor to take into account when you consider going into trading or investing. This is probably the most important factor to take into account when you consider trading. If you're not a disciplined person, don't trade, okay? Go work on your discipline first before you even consider going into trading. Discipline is what makes the difference between a successful and unsuccessful trader. The discipline required to become a successful trader is enormous. The market will, on a daily basis, make you doubt your own trades. The market will make you contradict your own decisions, whether you go into a position or not. And it will lure you into positions you should not be in. Discipline is the only thing that will save you during those moments. Coupled with discipline, your ability to cope with failure is another important point. When trading, you're going to fail, and you're going to fail a lot. I never met or even got to know of another trader that hasn't failed at one point or another. If you, by any chance out there, know of a trader who never failed, please get him in touch with me, because I would really like to meet that person. Your ability to handle failure is going to make the difference between you going home and crying yourself to bed, never wanting to touch another trade again, or you going home and the next day coming back for more after the market has beaten you down, and trying again to become a consistently profitable trader. What you want to do is aim for a 50% success rate. Half of your trades are winners and the other half is losers. Now, if you can do better than that, by all means, go for it. But with a 50% success rate and a profit and loss ratio of 2-to-1, you will be successful. Remember that the market has no consideration whatsoever for traders. This is the reason you have to maintain very strict discipline on how you approach every single trading day and what you do during the market hours. In this way, you'll be cutting your losses and reaping your profits as they appear. Many traders can be undone by stress. The ability to concentrate on the market and stick to your trading system, as well as staying calm and as rational as possible, could make the difference in your trades. Remember that your enemies are not the algorithms or even the other traders out there. Your real enemies are your emotions. Emotions of doubt, fear, greed, and hope are the ones that could bring your downfall when trading. And that is why keeping strict discipline during your trades is so important. Being a successful trader is all about how much you're going to trade and when to exit your positions. Just because you're a day trader doesn't mean you have to exit your positions only at day's end. You can place many different trades and enter and exit different positions many times throughout the day. You need to determine the size of the trade and the amount you're going to put into a position, and also determine the maximum profit or loss you can expect from that trade. Placing all your money on a single trade idea could be a really horrible thing to do. I know many traders out there are the type go big or go home, but more often than not, this is actually a terrible idea. Money management should always be taken into account when placing a trade. Placing all your money on a single trade puts you at risk of losing everything all at once. My advice is to divide up the money set aside for trading, manage it wisely so that when you do have losing trades, you still have some leftover cash to enter into other trades as the opportunity arises. Careful money management helps the trader stay in the game for longer, and the longer you stay in, the more likely you are to make good money. A good way of protecting your money is through the use of stop and limit orders. Now, I'll probably bore you some point in the future with stop orders, but they are very often overlooked by beginner and professional traders alike. Stop and limit orders are placed with brokerages at the same time as your trade, and they mean that as soon as a price hits a certain level, your stop or limit order automatically kicks in. For instance, you enter into a position, a long position, you buy a stock at a certain price, and since you did your homework well, you expect the price of the stock to go upwards. Now your stop loss, your stop order should be placed below your entry price, okay? Now for some reason or the other, the market turns and the price of the stock goes down. If it continues going down, sooner or later your stop order will be hit. As soon as the price of your stop loss is hit, you automatically cash out of the position. Now for sure you are going to take some losses, but since your stop loss was automatically hit, it stops you from losing even more money further down the road had you not placed the stop loss. So what do traders trade? Most traders pick one or two markets to trade in, which already gives them a good enough feel for the market, how the news affects the market, and how other traders react to the news. It is a good start, and if you keep to just one or two markets, excluding all the others, you can already start by making a decent amount of living through your trades. Now, of course, as you progress, you will be expanding into other markets. On different exchanges, you can trade almost anything. Futures such as the S&P 500, the Dow Jones Industrial Average, etc. Futures contracts allow traders to profit from price changes in indices such as the S&P 500 and the Dow. It gives traders exposure to prices at a much lower cost than if they were to buy the stocks in the index individually. Futures markets also tend to be more volatile than the indices they tracked since they are based on future expectations, hence the name futures markets. Forex and currencies. Now, foreign exchange involves currencies from all around the world, and traders look at those currencies in order to profit from the fluctuations in exchange rates of said currencies. This is the largest and most liquid market there is, and it is open almost all day, every day. Then, of course, there are common stocks and exchange-traded funds. The entire business of trading began in the stock market, and it continues to be popular with traders. They look for news on company performance and investor perception that affects stock prices, and traders look to make money from those stock price changes. Then, of course, there is bonds. This is basically trading debt from companies and governments. We have commodities, hard and soft, and of course cryptocurrencies. Basically, in the right market, you can trade almost anything and everything. So this was just a quick introduction to day trading. I will be getting into more technical analysis and fundamental analysis in later videos, but just remember that trading can be a really difficult and complicated job. I know with today's modern technology it has become easier, but the basics of it can still be very complicated and stressful for a lot of people out there, so you have to keep that in mind. Also remember that you will be faced with failure. You will have losing trades, and you will have many losing trades, and you will even have big losing trades. But if you stick to the market and do not turn your back when faced with failure, you could become a successful trader. Remember that discipline is key. If you do your homework well in advance and stick to the rules, you will be getting better on a daily basis and you will become successful in your trades. If you have any questions for me, please leave them in the comment section down below. I'll try to respond to them. Leave a like on this video if you liked it. I would appreciate it. Thanks for watching and hope to see you guys in the next video.